Let's sell the shares. So what happened when they merged is rather than having one company buy the other, they decided to keep the two companies as being separate, but instead they merged their assets. So Royal Dutch and Shell merged all of their energy assets together. They kept the two separate companies in the Netherlands and in the UK, but then they agreed that any profits which came from those assets would be split 60% to Royal Dutch and 40% to Shell. Why? Because at the time that they combined the assets, Royal Dutch's assets were worth 1.5 times what Shell's were. And so what that means is that at any point in time, theoretically, Royal Dutch's shares should be 1.5 times what Shell's shares are. But that's theoretically. Right? There's nothing in the real world to say that this equation needs to hold. And so what happened was that if, indeed, the Dutch stock market did really well, then all Dutch shares did well, then Royal Dutch went up, and maybe this, which should have been 1.5 times that, it became 2 times it. People forgot that Royal Dutch and Shell should be linked. Instead, Royal Dutch went up with the overall exuberance of the stock market. So you might think, well, if that's the case, isn't there an easy trading strategy here? If Royal Dutch is too expensive, I'm going to buy Royal Dutch, and I'm going to short Shell. But the problem is, whatever irrational exuberance caused Royal Dutch to go up, it could get even worse. So maybe the Dutch economy does even better, and now Royal Dutch is now 3 times the price of Shell. Now, you as the investor, you're making a loss because you've bought something and then it's actually gone down in value. You hope that it will go back down to 1.5 to 1, but in the interim, it's gone worse from 2 to 3 rather than down to 1.5. And you might claim to your investors, oh, stick with me, trust me.